All right. I think we're live. Yeah. It looks like we are back. All right, let's see if we get some people to come online here. Let me see if we're hitting any social media channels. It's starting. Let me see live. Here we go. Looks like we're going live here. Slowly but surely. Hang in there for a minute. I'm gonna give it just a minute and a half, couple 1 or 2 minutes, and I'll get started. I just want to see who else is gonna join us here. Um, for you that is already in the room, or for those of you that are already in the room, we are gonna talk about identifying stock market tops and bottoms. Effectively, we're going to talk a lot about tops today because it is important at the moment. And the reason we're going to talk about that is because I have found throughout my career that most people really do know how to make money in an up market. There's a reason for that. The market's going up. It's why right now we have a plethora of 23-year-old kids and 24-year-old kids telling people they're going to teach them how to trade futures and options, because the fact of the matter is they're just buying to the high side. And right now, when you're in a bull market like this, a bull market, a positive market, prices are rising. When you're in a rising market like this, you can't miss. If you just keep buying to the high side, and even if you're in options, if you buy out just a month or two, and you've been doing that since the bottoms in October of 2022, which you haven't been because you weren't confident enough to buy back then, that's when the market was bottoming out. That's when there was actual strength. Right now, the market's showing a lot of weakness. So that makes people very excited because, believe it or not, stock market weakness comes with high prices, not low prices. I should actually write that down. Stock market weakness comes with high prices, not low prices. I'm going to write that down. Stock market weakness comes with high prices, not low prices. I like that. All right. So it looks like, I mean, is this possible that it looks like there is one person watching me here. I'm going to go anyway. I don't mind. I actually enjoy doing this. I like talking about it. So I will, in fact, if you are the only one watching, welcome. I'm glad to have you. I'm glad to see you. I'm going to get going anyway. So let's talk about let's just talk. Let's just have a brief conversation about the market, the participants, kind of how they all interconnect and create this stock market as we know it now, and what that means to investors and investors or traders, and how you can, with that knowledge, how can you use that to protect your assets when things are actually when there's weakness in the market, meaning prices are high, and then when to know to go into markets when markets have strength, which is typically at a low price. Markets are strong and weak inversely to the common man's thinking. Because people are emotional. We're emotional creatures. We get fired up easy. Believe me. If you don't have strict rules and strict discipline on how you're going to handle market price movements, you will mess it up every single time. It's not your fault. It's going to play on your emotions. A lot of times people will say, well, I invest like Warren Buffett does. Well, do you? Right now, Warren Buffett holds more cash in Berkshire Hathaway than at any point in history. Now, you could argue that right now, with inflation being what it is and currency being where it is, does that actually mean, as a percentage of assets, that he's holding more cash now than he has historically? And I'll answer that for you. Yes, it does. He is holding more cash as a percentage basis than any time in history. And there's a reason for that. We are in a market that has incredible amounts of weakness right now. It's pretty easy to identify. And in fact, as we're talking about it, the thing that you have to realize when you talk about market strength and market weakness is market strength is often the point at which institutions, so big brokerage firms, trading desks, big institutional trading desks, market makers, these guys, that's when they are buyers. That is where strength comes in, is when they are buying. Now, the professionals on Wall Street that make Wall Street tick every single day, they're in there every single day watching Wall Street tick. Now, some of these guys, like market makers, for example, they have no dog in the fight of which way the direction is going to go. Their job is to create this market to allow these transactions to happen. So, really, all those companies are doing on any given day is spreading out risk to the point that their firm is taking on zero risk and making profit. Is that possible to do every single day? No, but that is the goal every single day. Now, they're the bottom layer because they're creating the transactions. Then you have trading desks of big firms on Wall Street, right? Whether it's banks, whether it's brokerages, hedge funds, whatever. You have trading desks. These are the guys that are there every single day looking to buy and sell stock and make money, or buy and sell commodities and make money. If you're on a derivatives desk, or if you're on the commodities floor. So those guys are trying to buy and sell and make money every single day, right? And then you have your retail investor, right? That's the person that is trading his account on his own, and he's in there and he's trying to buy and sell at opportune times. Now, I can tell you an interesting fact about the retail investor. So I was a financial advisor for a couple of the major firms on Wall Street for about 15 years, and then I ran my own shop for about 10 years. And what I can tell you that I saw on a consistent basis, especially I would say with 95 plus percent of the advisors that I worked with, regardless of where I worked. And I worked at Merrill Lynch, I worked at Wells Fargo Advisors, I worked at some of the biggest on Wall Street. I can tell you that 95% plus of the brokers in those places were only using asset allocation. They were great at gathering assets. They really didn't know why the market moved in any specific direction. They would read a report that would come out from the firm in the morning. So if the market started falling and they started getting calls, they basically would read this stuff. They looked at CNBC quite a bit and they gave you answers that way. And the truth was they didn't take the time to educate themselves on how and why markets moved, because that is not they are not rewarded for that behavior. They're not meant to know how to do that. That's not their job. I mean, contrary to public opinion, and I worked there, I can tell you that's not their job. They're not incentivized to learn how markets move and make the clients an additional 10%. They're just not. Think about it. Just you use common sense. So if they're charging 1% fee on assets, if they bring in $1 million account and they get to charge 1%, they're going to make $10,000 a year on that account. Now, if they make an additional 10% for that account, which means, thousands and thousands of hours of learning, trying to master how to use these markets and work within these markets so that you can do an extra 10% in that account. That means you make an extra 100 grand for that person, which is amazing for the client, but that makes you an additional $1,000. Now, is it worth thousands and thousands of hours? Or like if you're in this situation, if it's you and it's your job, is it worth thousands and thousands of hours to figure out how to make an extra 1,000? Or could you spend an extra 20 hours and figure out how to bring in another million and make another 10,000? There's the system. The system incentivizes them to bring in assets, not to manage it. They pass that off to someone else, and that someone else rarely is able to even compete with the index. So there are very, very few funds, whether it is mutual funds or ETF management funds, very, very few that will beat the S&P 500 on any 10-year return scale. Very, very few. Why is that? Well, it's simple. Regulations is one answer. Two, they have massive amounts of assets. So even if they see something coming, oftentimes they couldn't get out of the way if they wanted to. Now, the individual investor can get out of the way quickly. It's his money. He can sell it all if he wants. He can buy it all now. Your standard retail investor isn't somebody that goes out and really tries to educate himself, which is the big problem. And this is what I mean by that statement. From 1990 to the year 2000, the S&P averaged 11.2% per year. So per year, 11.2%, the S&P 500. The average retail investor, do you know what they averaged? Do you know what their return was in their account? The average return for the investor, the person, was 1.2%. That's it. A little over 1%. Why is that? Well, simple. They bought and sold at the wrong times. It is that simple. They bought and sold at the wrong times. Why? Because they didn't educate themselves, they didn't have a disciplined approach, and they allowed their emotions to guide their decision making. In the game of finance, and I don't care if you're in loans, if you're like in lending, I don't care if you're in crypto, I don't care if you're in stocks, bonds, commodities, in any of those games, your emotions are wrong. 99.9% of the time, your emotions are wrong. And they're wrong because you get excited when you make money and you get upset when you lose money, which is natural, right? So it's not like you're out there making these monstrous mistakes. It's just that when you make money, you get excited because making money means that you'll maybe have a few more choices this year. Maybe you can decide like on a nicer vacation, or maybe you can decide, or maybe you're able to pay off a mortgage, which gets that weight off your back, or maybe you can get rid of that car payment that would make every single month a little easier on you. Right. So this money means things to us. It's not just dollars on a page. And that's where a lot of people get screwed up because they see these big managers, guys like Warren Buffett, and they say, I invest like Buffett. And I say, no, you don't. The numbers on his screen don't mean anything to him. Why? They're so large, he can't be impacted. That's why. If you let me ask you a question. Let's just say billions, and he's way above this, but we'll say billions because this is what he had back in like 08. You have $5 billion, right? Market falls 50%, you fall 50%. Now you have $2.5 billion. Can someone tell me how that's going to affect your life? It doesn't matter. You're not in his position. You can't invest like him. So quit pretending or trying that you can. And like saying that you can't do it. If you have $1 million and I cut you down to 500,000, what's going to happen to your life? Be honest. Everything has changed. Everything has changed. Everything. Nothing will remain the same after that. That's why the lower you are on the totem pole of life. So I always when I talk about life, I always talk about life as a ladder for a couple reasons. I mean, for one, I believe you grow throughout your life, and I don't think it ever stops. And that's this upward momentum. And the reason I say it's like a ladder is because the higher you climb, the more tired you're going to get as a human being. Why? And don't listen, like it matters where you started, believe me. And I'm going to get to that in a second. It matters where you started. The reason is the more rungs you have to climb, just like in life, if you have 1,000 rungs to climb and your neighbor has 100 rungs to climb, by the time you two get to the same place, you're utterly exhausted and you're going to collapse. And he's going to look over and go, I did that easy. Okay, right. But he had 1,000 to go up. You had 100. Of course, you have an ample amount of reserve energy. And of course, he's annihilated. It's not like anybody should be mad about it or it's worth like a ton of discussion. But the fact of the matter is, in life, the lower you start, and this is the additional struggle with the lower you start. This is why when you don't have much money, you have to be so much more careful. Because the lower you start on that ladder, the more perfect you'll have to be to keep up with. And when I say keep up with, this isn't about keeping up with the Joneses. This is about having a decent life where you get to have some choices, some freedoms. You're only going to be able to take your life so far, no matter what social media says. You're only going to get so far. But if you're starting at the bottom, you're going to need to know how to avoid some of those bear markets, or at least chunks of those bear markets. And the reason for that is you're not Warren Buffett and you don't have $5 billion. And by the way, that was forever ago when he had that money. That was back in the 08 and 09 crash. Guy had so much money, Goldman Sachs had to borrow money from him. 500 million. He got 10% preferred stock from Goldman Sachs. And then I forget what the rate of return was. Goldman paid him back in less than a year, but Goldman had to borrow money from Warren Buffett. So don't tell me that you invest like Warren Buffett, because you don't, and you'll never be able to. Okay. You don't have that kind of money. When your money gets hit, you're affected. When his money gets hit, what's the difference? It's just numbers. Hopefully he has enough in cash reserve. Like right now, he has more cash on hand than ever in history. Why do you think that is? Because he knows there's going to be a buying opportunity coming. Maybe it's this year, maybe it's next year, maybe it's in a month. He doesn't care. You do care. And so you need to learn how to identify this stuff. How do you identify tops and bottoms? And I'm going to show you that. We're going to talk about it today. And right now, what I am doing, because I do believe that the lower off on that, on the ladder of life that you start, the more perfect you're going to have to be. And I know that to be true. The more perfect you're going to have to be, because you can't afford to lose 50% of anything ever. It'll annihilate you. It'll destroy you. So I have an intermediate trading, investing, and forecasting course. What this course teaches you is how to identify when big money, when people that have lots of money, or the more knowledgeable hands of the market, when they are shifting from one asset class to another. Okay. So when that happens, you know how to identify that and you know how to move with them. For example, the S&P 500 hit 6,000 for the first time. We have an inflow of cash into the S&P, and guess what? We have an outflow a huge outflow in the technology, AI, and energy sectors right now. A huge outflow. But if you're not paying attention to that, you don't know how to identify that. You don't know what to do about it. So right now I'm offering this course at 95% off for $100. Because I don't want money to be the reason that you say that the next bear market takes 50% of your money because you didn't have a chance. You didn't know, no one told you. There it is. There it is. Take advantage of it. I'm going to leave it up here for just about one more minute. And what I'm going to do is I'm going to very, very briefly show you what this course is going to teach you. It's going to teach you how to look at price. It's going to teach you how to look at trading activity. It's going to teach you how to look at time frames. And it's going to teach you how to look at gaps and know with a pretty high degree probability when you are entering a stage of weakness in a stock market and when you're entering a stage of strength. I think today there's only a couple viewers on right now, so I think what we're going to do is we're going to go through areas of weakness. I think right now we're going to explore market tops. I think that's far more important given where we are in the stock market now than anywhere else. I'm going to show you how easy this stuff is to identify. And hopefully, when you see how easy it is to identify, and trust me, it's easy to identify, as long as you can keep your focus and your discipline, if you have a discipline, hopefully you have a disciplined approach. I find most people don't, but if you in fact do, here, let me pull this down. If you maintain that discipline, I have a course that can show you how to identify market tops and market bottoms to a high degree of accuracy, which will help you build your assets the way you would like. You'll be optimizing your investment assets. Earlier, I talked all about the financial plan, how that works and why that works. And I told you that tonight, what I want to talk with you about is optimizing your investment assets. So let's have a brief conversation about what you look for first. So volume. What's the importance of volume? Why does volume matter? Volume is nothing more than trading activity. Okay. It tells you how much trading is occurring in a given day. All right. Now, there's one group of people that produces massive trading activity. There's only one group, and that's institutions. And you call them the more knowledgeable hands. You call them big money. You call them Wall Street. I don't care what you call them. But those are the people that have the ability to create large amounts of trading activity. First off, most of them know each other. Most of them talk. It's not like there's this collaborative effort to do this or to do that. But the fact of the matter is, they're all financial professionals. They're all involved in the market. And like any other person in business, they discuss their business with one another because they're friends. A lot of them have gone to the same schools. They belong to the same clubs. It is what it is. Okay. So they communicate. So what you're looking for when you're looking for tops or bottoms, the first thing you want to see is massive levels of trading activity. Because if you see a ton of trading activity and you know what chart to look at and when to look at it, which you will find in my course, then you know how to identify tops and you know how to identify bottoms. Now, there's some caveats to this, which is why the course is so important. But what I'm going to do now is I'm going to share my screen with you. I'm going to pull up a chart. Why do we look at charts, everybody? Is it so that we can look fancy walking through charts? No, it's because the economics that you read about, this makes me laugh because every day I listen to what this report's going to do or what that report's going to do. The economics of today were priced into the stock market 6 months ago. That is why when you have any economic announcement, the stock market will tend to have some crazy some whipsaw and then go right back to the direction it was traveling. Why does the market do that? Because the fact is that information is basically known 6 months ago and the market has already factored it in. That's just gamblers getting in there trying to suck some money out. That's what it amounts to. And 99.9% of the time on any of these days, whether it's Fed decision day or whatever earnings, there's a setup that can identify what's going to happen, and B, it's already factored in. So look at the general direction of the market. Unless you're lying flat, unless for some reason you've been flat for a couple of months, then maybe you don't have a sense of the general direction. So just stay out of the way, right? Just stay out of the way. So let's cruise over and let's take a look at a couple of the bear markets that we've gone through. So what we'll look at real quickly, and I'm going to look at the intermediate and long term. I'm just going to pull up the S&P 500 from 2007 and 2008. And you tell me, I am not here to convince anybody. If you think that this is wizardry, and when I pull this up, you go, yeah, but first off, send me a message if you feel that way, or make a comment on the video. I don't care how you do it. Just get to me because I would love to hear what someone thinks. So we're going to look at the S&P 500. We'll do that in 2007, 2008. And then we can go to this most recent market decline, which was December of 2021 through October of 2022. We'll take a look at that top. All we're going to look at, because you can refine this down to target levels, so price targets, and you can refine it down to time frame. But the first thing you have to see are these massive amounts of volume. Without those massive amounts of volume on a weekly chart, you need to see a massive amount of volume if you're an intermediate or long-term trader. Without the massive amount of volume, I don't really care what's going on because institutional money is not selling out for any type of major market correction. If there is a 10% drop, it's a buying opportunity. If there's a 5% drop, it's a buying opportunity. What I'm telling you to do is just avoid major bear markets. And by avoiding major bear markets, you'll take your average of a 10% return, you'll turn it into a 20% return, and you don't have to know that much to do this. Okay, my investment knowledge goes way, 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 way beyond this. I have been doing this for 25 years. But what I tell people is you've been told that this is something so complicated that you can't do it. And what I'm here to tell you is, yes, you can. This is not difficult stuff. This is not watch. Let's just get a chart pulled up. Okay, so we're going to go. Let's go to the S&P 500. We're going to go ahead on a weekly chart. We're going to move back. Actually, let's zoom in a little bit on this. There we go. We're just going backward in time here, everybody. So if you can see 2007, 2008. Now I want to show you something. All right, you see that? See the dates at the bottom here? Let me make sure that this is being shared. Yeah, there we go. Okay. So let me go back to the screen. I just wanted to make sure that was showing up appropriately. So you see the dates at the bottom, 2007, 2008. I'm going to get rid of those two arrows because what I want to do is I want to show you something. So this right here is 2003, okay? This is the market bottom. This is the tech bubble burst, but we're looking at the S&P, not the NASDAQ, but that is the tech bubble that burst. So this is the stock market here in 2003, right here at the bottom. Now, as we move forward, this is 2005. I want to show you something. (2007), there you go. You're rescaled. You just rescaled all the volume on the entire chart right here. This is February 26th of 2007. This is where the volume is. It's that high. Look at the rest of the volume on that screen. It literally adjusted the volume on the screen. Right here, the S&P 500's at what? 149.53. So if you were a person of, reasonable intelligence, and you realize that for volume in 1 week to go up, what would you call that? 300%? I would. 300%, why not? If it goes up 300%, you go, okay, there is an indication that maybe something is going on with the institution. So you ask yourself, well, how much has the market risen? Well, down here you're at 80, up here you're at 150. You're almost at 100%. So you could reasonably sell out here and just say, I am going to wait for a large market correction before I buy back into this thing. But then as you scooch over, boom, look at that. This back here, this was your high volume that towered above everything behind it. Here you are right here. What is that? July of 07. July of 07 has reset. Now, at this point, everyone, I want to tell you something. This was the point at which I can tell you I was managing money back then. This is the point at which I knew we were in trouble. This is July of 2007. Nothing really bad has happened yet. But you mean to tell me you can't see this? You can't see that. You can't see that the market's up 100% and your volume has just, I don't know what that's up, 10 times, 800%, I don't know. What is it from here? I don't know, 500%, 800%? You get out. This is a market you get out of. Now, get market neutral. Now, the big money in the industry, right, the more knowledgeable hands, they don't have that option. They're not allowed to get out. Why aren't they allowed to get out? Laws and regulations, listen to me. If you're a large cap growth fund, if you're a stock fund of any kind, you have laws that say that you are not allowed to be anything less than 90% invested. And you have to rebalance once a quarter. So you have to correct what you're doing once a quarter. So they see this too. Make no mistake about it. I'm not showing you something that people on Wall Street aren't very, very, very well aware of. And they know exactly what to do with their personal accounts when this happens. But they're not able to do that in their business accounts because of regulation. They're not allowed. All right. Now you scooch over. Look at that. And now you get into lows, so it resets again. We're not going to, as I said to you, I'm not interested in talking about bottoms today. Look at this. Ready? Here you go. Look at that. You didn't know to get out? If you worked with someone and they didn't know to get out, they don't know what they're doing. They don't know what they're doing. So I hope that hit home with some of you, and you can see how easy that is. So I'm going to throw this course up again one more time. Here we go. Coupon code. There we are. What this course does is it goes much deeper than what I was just showing you now. But what this does is it shows you how to identify those tops, how to identify bottoms, right? So there's no trickery here. It just takes it into more detail than what I just showed you. The fact of the matter is you could pull up a weekly chart, and if you see volume up 300%, 500% on a weekly chart after the market's rallied 100%, you should get out of the way. Market neutral. You should get out of the way. That's not a place that you want to be. I'm going to leave this discount at 95% discounted down to $100 until Tuesday at midnight, or until I sell 1,000 of these courses, whichever comes first. So if I sell 1,000 courses first, perfect. If I don't, it's up until Tuesday night at midnight. Okay, I'm going to take this down. I want to look at another area because I want you to realize that this is not This is not something that is not only not difficult to identify, it's not like there's any trickery. It's not like you can't do this over and over and over again. So let's go back and let's look at the NASDAQ in December of 21. Because that was the here, let me get rid of this. That was the most recent market correction. That's why I said let's look at it. Oh, I have this for a student of mine. Okay. We were doing I was showing the basics of Elliott wave here and Elliott wave theory, because Elliott wave is an amazing way to identify time frames and market direction. So here we are, and the interesting thing here is the 2020 flash crash, because it really doesn't do justice to what you see here. But so you have the 2020 flash crash. So this is massive volume, okay? As you come over, so here you are. Let's walk through it. So here's 2020 flash crash. You're walking over. You have some decent volume and nothing that gets to a level of the crash. Coming over, here you go. Now you see this bar? There's two things important about the size of that bar. One, we just talked about it. The fact of the matter is, your average volume is probably where? There, that's probably your average. So you're at what? 300% higher. That's what I would say, 300% higher. When is this? This is January of 2022, okay? See this volume here? That's November of 21. That's December of 21. These are the lightest trading days. These are the lightest trading months that you have. And here you are, probably 100% higher in volume in November, another 100% higher in December, another 100% higher in December, until you get to about 300% higher in January. If you're not out at this point, that makes no sense. You want to wait for a rebound? Go ahead. It doesn't matter. But if you're an intermediate or a long-term investor and you didn't get out of the way of that, again, that's your fault. This stuff is not hard to see. And it shows up that way time and time again. Time and time again. Now, we won't get into market bottoms today because I don't have the time. I am already 33 minutes in. And I wanted to give you a taste of that course. That is just a taste. We didn't touch time frames. We didn't touch price. We didn't touch gap. We didn't touch how to identify bottoms. That course is very detailed. Five hours of video tutorials, 20-page workbook, everything you need to use volume, price, gaps, and time frames to identify market tops and bottoms, and learn how to avoid large stock market correction. How to avoid large stock market corrections and how to protect your account from those corrections. I'm going to throw this QR code up one more time here. There it is. And here is the coupon. There you go. And so I'm going to let you guys scan that if you're interested. This is good until Tuesday at midnight, or if I sell 1,000 of these courses first, that will be the end of it. Yeah. So there it is. There's the QR code. There is the coupon code. I think, for now, that's probably enough on the live. I didn't have a lot of viewership. And I don't have anybody really chatting. So I think I'm going to jump off now. I hope that was helpful. I hope you enjoyed it. That's always the goal. And the goal is always to educate. And if you have any questions, please reach out to me. Let's see here. You can see I'm at prometheaninvesting.com. Let me go over here and I'll throw up my email address. If you have any questions, my Twitter is Derek Invests. And then my email is there, dmiller@prometheaninvesting.com. Please feel free to reach out, question, comment. Question, comment, anything, anything you have. All right. But for now, I'm going to go ahead and jump off this live. Thank you all so much for